The October reopened the issue of fxd1 2016-10 and fxd1 2022-10 have just concluded, and here are the results. Total bids that were received amounted to a 50.9 billion. That accounts for an oversubscription of 169%, which is spread out as 122% for the fxd1 2016-10, which gave the investors 2-year maturity or 22 months to maturity. Then about 47.8% for the fxd1 2022-10 for the 8-year issued bond. That oversubscription realized a market-weighted average rate of about 17.3% for the two bonds, and that consequently led to rejection of bids, and the amounts accepted, or the accepted bids, realized at 31.2 billion. That is 1.2 billion above the target amount, and that was meant to align the weighted average of the accepted bids to the current market interest rates of about 16.8%, and therefore the weighted average rate of the accepted bids stood at 16.9%. The prices, or the resultant clean prices of the accepted bids, stood at 99.2731 for the fxd1 2016-10 and 91.2024 for the lower coupon fxd1 2022-10. Considering accrued interest for the two reopened bonds, you must have noted that the amounts that you are required to pay for your successful bid is more or less equal to the face values, because the marginal discounts out of the bids, especially for the fxd1 2016-10, which stood at the clean price of 99.2, and add an accrued interest of 2.7 for every 100, that should have given you about 101 shillings per every 100, and therefore the amount that you are required to pay, or the dirty price for every 100 of what you are supposed to pay for this bid, may have crossed the par value. And the same for the second bond. That is occasioned because of the marginal discounts that you are getting from these issue were consumed by the accrued interest that you are supposed to pay on top of the clean price. That is what necessitated your price, the amount that you are paying, to be almost equal or slightly above your face values. There are 5 important elements that must have necessitated the oversubscription of these bonds, because considering the coupon rates that these bonds are paying, that is a 15% for the 2-year maturity bond and 13% for the 8-year maturity bond, and considering the prevailing rates issued by fund managers in the money market funds, which are the common form of investment by majority of the retail investors, and the current market interest rate of 16.8, these two reopened bonds were considered to be averagely low coupons, but they have ended up accruing an oversubscription, and we have the 5 basic elements that must have necessitated that as oversubscription, and they are important for you to understand them because they are the basic elements that you need to be considering in future for your bond investments. We'll be looking at those 5 elements after 3 seconds short break. In the meantime, like this video, engage us in the comment section. Give us your opinion, give us your comment, or any question, and we'll be responding to those questions almost immediately. And don't forget to share this information or this video to another person. See you after 3 short second breaks, so don't go away. Thank you for staying and welcome back. Let's look at the first element, and that is the point of coupon rate. The issued or the oversubscribed reopened bond, that is the fxd1 2016-10, this bond has a coupon rate of 15.039%. That rate is given gross of withholding tax, or it includes the withholding tax, which is supposed to be 10%. The reason for 10% is that as per the law, bonds issued for a period of 10 years and above are taxed at a withholding rate of 10% and not 15%. That gives us a marginal difference of 5% when you compare with the withholding tax rate applied on interest that we earn from money market funds, fixed income funds, and other collective investment unit funds. That consequently then gives us a comparative data with the prevailing interest rates from money market funds and fixed income funds as follows. From this schedule, you notice that the prevailing interest rate as per the money market funds yields a data of only 2 money market funds who are giving interest rate above 18%. Then we had 4 money market funds that yielded a return of above 17%. Then 3 gave us a yield of above 16% or of 16% and above. Those are the yields that are above the yield that we are getting from the bond, that is 15%. If you subject these yields to withholding tax rate of 15%, then the resultant net interest or return from these money market funds stands at 15.3% for the 2 money market funds that are giving us 18%, then 14.75% for the 4 money market funds that were giving us 17% and above, and 13.6% for the 3 money market funds that are giving a yield of above 16%. Compare that data with the net return or net coupon that you are getting from the fxd1 2016-10 of 15.039 gross, and when you subject it to a 10% withholding tax, you are getting a net coupon of 13.4%. That gives you comparatively that we have 16 money market funds that are yielding a return that is less than what this bond was giving. And another important factor to look at is that these 16 money market funds, they control over 85% of the fund value held by money market funds. If you consider the fixed income funds, only 2 fixed income funds are yielding above 16. So making the rest give a return that is way less than what this bond was giving. And that means that where majority of the money market funds considered these bonds a good issue because its return is way above what they are paying out as a return to the fund members. And therefore, considerably, that is, you notice that it had heavily oversubscribed by the competitive bidders, where majority of the competitive bidders immediately come from the money market funds or the collective investment schemes. The average interest or yield by the money market funds stood at 15.45% gross of tax. The third element to look at after the coupon and the tax element, regulation. The recent review by the regulator, that is Capital Markets Authority, extended the maturity or the investment horizon for money market funds by the fund managers from 12 months to 18 months. And that means that the money market funds are closing in to compete with the fixed income funds, which have no limitation. They invest both in the money market and the capital markets. They invest in both short and long-term bonds. But the money market, the extension or the stretch of the horizon of the money markets to 18 months opens a window for the fund managers to invest in longer maturing instruments, putting them in the same market with the fixed income funds. And for that reason, then that gives these bonds another range of a market or opportunity from the money market funds. The fourth one is risks associated with the money market funds. Bonds give you or solve the problem of predictability of incomes. A bond gives you a guaranteed fixed return at a known date. So that makes it easy for planning by the investor or budgeting. And on top of that, another solution that we get from investing in the bonds is a protection against volatility of the market interest rates. Money market funds respond to changes in interest rates in the treasury bill market. That's why a majority, over 90% of the money markets funds, they benchmark their return with the return by the 91-day treasury bill. Only one money market fund, and that is the Jubilee Money Market Fund, benchmarks its return with the average fixed deposit return by banks. That then makes the bond lucrative, especially when it comes to long-term investing. Money market funds are structured or designed for short-term investing that makes it suitable for emergency funds and short-term goals. And that's the reason you either push for the bond investing or the fixed income fund investing, as we shall be seeing in our subsequent video. And the last and very important is element number 5, which is a limitation to money market funds when it comes to long-term goals. And that is the good attributes of the money market funds that make it suitable and good for short-term investing and emergency funds make it a risk or a challenge, a problem when it comes to long-term investing, and this is accessibility of those funds. Money market funds or these collective investment schemes, especially the money market funds and the fixed income funds, make the capital or the money invested in those accounts easily accessible by the investor. And that poses a risk or a danger to long-term goal investing. And therefore, when you put your long-term goal investments into the bond market, that makes that amount unavailable to you as an investor. Only the return element, the coupon element, might be accessible on the due date, but the capital amount, if kept for a long goal or invested for a long purpose, then it becomes a good attribute for this particular bond. And especially for a medium investor or for a medium goal, because these reopened bond gave us a maturity period or an investment period of 2 years. So the basic part is that the accessibility aspect of money market funds and fixed income funds make it unsuitable for long-term goals investing. Thank you for watching.